Well, hello again, everyone, and welcome to 2021. The Rumble's already underway. Dion Zakuski, Branch Manager and Director of Wealth here at Scotia, back with you for our first video of the year. And today, we're going to look at our main investing themes that we're focusing on, what the risks are to those themes, and of course, regarding strategy, what to do next. So after pouring through a few hundred pages of reports, forecasts, research papers, and so on, we've dusted off the old crystal ball here in January, and we'll share it with you. The game plan for this year looks to be one of global recovery, and we think markets will go along with it. What are these magical tailwinds of dollar signs? Well, we've summarized them into three themes that we want to share. First is the global synchronized downturn is already into a synchronized upturn. Similar to our old pal Isaac Newton's third law of motion stating every action has an equal and opposite reaction. If investing was just that easy. But nope. However, markets have rebounded very well off their lows last March, and this has been helped by central bank policy setting interest rates at very, very low levels. We'll check out more into this in a minute. Many leading economic indicators are showing strong recovery signs, and Scotia Economics predicts that most major developed economies will grow by about 5% this year. Emerging markets may be growing by about 8%, such as China, which is growth we haven't seen for years. The second theme is cash on hand. Obviously, there are still lockdowns due to COVID, but once lifted, we should see a sharp increase in consumer demand. That will boost the economy. We looked at some US data. We used the US because it has the largest economy, and we looked at their savings rates, which we're going to share with you on a chart here. So as shown, cash held in US savings accounts, which is the blue line, has increased by about $2 trillion since last February. Right now, that sits at almost $12 trillion in deposits. That's a massive increase. Trillion with a T, folks. Combine this with a healing job market and even more government money being sent out, and there's a lot of cash on hand that's going to be waiting to be spent. But it's not only the consumer who's built up cash. There are also sizable amounts in corporate America as well. Cash as a percentage of assets for companies hasn't been at these levels since the 1950s, as many companies are waiting to expand as the COVID recession finishes, as well as restocking their inventories. Our third theme to watch is the ongoing effect of very low interest rates. As mentioned, an amazing global effort happened last spring when the world central banks lowered interest rates and provided stimulus measures to both individuals and businesses. With most central banks committing to keep rates very low, including our own Bank of Canada, this will help spur on the economy, since borrowing remains super cheap. Related to this, dividend-paying companies will also see a rise in their stock prices as the bid will continue for more yields. Right now, it's pretty difficult to achieve decent portfolio yields from traditional fixed income. Okay, so this all sounds amazing, right? Well, as we know, though, economies and investment markets don't move in straight lines. So what are some of the risks hanging out there to our major themes? Of course, there's the ongoing circus in Washington, but we believe that will be very short term. Zooming out, the main boogeyman remains future waves of COVID, and that is causing renewed lockdown measures in parts of the world, including some Canadian provinces as well. Markets are assuming a perfectly timed recovery, and if it turns out to take longer than expected, that will definitely cause some market bumps along the way. As we know, the main difference between the spring lockdowns and the ones being experienced now is the approval of available vaccines. Scotia Economics predicts that more than 6 billion doses will be produced here this year, and we're going to show you some of the main players that are involved. Looking at the chart here, right now there's more than 6 billion doses that are being planned, which should result in about half of the world's population being inoculated. The companies that are mainly involved in the vaccinations are AstraZeneca, Pfizer, Sputnik, which is the Russian company, and Moderna. So this is all really encouraging, but a huge challenge still remains, such as distribution, acceptance, and of course, effectiveness. The other risk hanging around is if central banks start to leave the team effort in keeping interest rates as is. In the first wave, all of them acted in unison and also provided massive stimulus. But what we've seen in the second wave, it has been different, as the European Central Bank and a few others have actually added more rocket fuel stimulus to helping things along. But here in North America, the US Federal Reserve and the Canadian Bank of Canada has actually kept programs status quo for now. All right, so now we have all this amazing information. What do we do with it? How do we approach the year as far as an investment point of view? Well, when it comes to strategy, we feel it really comes down to short-term versus long-term, kind of like those boxing gloves we talked about and showed you at the beginning. Shorter-term risks such as US politics and COVID are definitely out there. But we believe the longer-term tailwinds of rebounding economies, increased consumer demand, and very low interest rates will win the day. Our game plan remains to try and capture growth where possible, but we also want to keep risk in check as well. As always, the best strategies maintain a steady hand, and if you have questions about your portfolio or strategy, please give us a call. We're here to help. And that's all for now. Stay safe out there, and thanks for watching.